Hi, welcome back to another episode of Just Jim, where I provide merchant education. Today, I'm going to be chatting with you about a new IRS rule that has the potential to affect you. Digital payment platforms such as PayPal, Zelle, and Venmo were originally intended to allow friends to quickly transfer money between each other. Cash apps provide a quick and easy method for splitting the check in a restaurant, loaning a friend money, or even paying for Girl Scout cookies. Let's look back at the history of cash apps. The original Cash App was PayPal, which launched in 1998. The idea was simple and efficient. PayPal users would share their emails, banking, and credit card information in return for fast, low cost payments. Small businesses and consumers quickly embraced PayPal, with the company handling more than $3 billion in payments from 10.2 million consumers and 2.6 million merchants within 3 years of opening their door. However, after just 2 years, the founders decided to focus solely on payments on the internet through website transactions. PayPal now has more than 286 million users transacting business. While PayPal met the needs of merchants, it didn't really address sharing money between two friends. That gap was bridged by two young men who were randomly assigned to share a college dorm room. They launched their platform in 2011 and took the stress out of exchanging money between friends. By 2020, some 52 million people were using Venmo. It was not surprising that PayPal bought them out just 1 year later. Realizing that cash apps were the way of the future, several US banks got together, including Capital One, Bank of America, Chase, Wells Fargo, and US Bank. They joined forces to launch Zelle. Now, that's a cash app that can transfer funds from one bank account to another. And Zelle's lack of fees offered a very distinct advantage over the other cash apps. Zelle attaches a bank account with a mobile number and email address of a user. Anyone sending money to another Zelle user account must know the mobile number and the email address of the recipient. Today, many businesses are accepting payments from all three of these digital payment platforms. As a result, the IRS has implemented rules for reporting cash app payments received. As a merchant or an individual, you need to know the IRS rules for reporting cash app income. In the past few years, many small businesses have embraced the use of digital payment platforms. With a cash app, small businesses, farmers market vendors, hairstylists, just to name a few, are able to accept payments in a more modern way than accepting checks. They don't require a credit card terminal, a point of sale system, or anything else other than a mobile phone. With cash apps growing in popularity, the federal government has stepped in to change tax laws with respect to reporting income received from the cash apps. Whether you're a small business owner or just someone who uses cash apps to transact business, you need to know how these new real rules affect you. Previously, limits surrounding the reporting of income received through payment card transactions were pretty lax. Businesses and individuals would only receive an IRS Form 1099-K, that's a payment card and third party network transaction document, if the following two conditions were met. First one, you had to receive payments of more than $20,000 in a single year. And the second one is you had to complete more than 200 transactions per year. Either of those two could trigger the 1099-K. However, the American Rescue Plan made changes to these regulations, and now cash apps are required to report payments totaling more than $600 for goods or services. Beginning this year, Cash App networks are required to send a Form 1099-K to any user that meets this income threshold of more than $600. A copy of the 1099-K will be sent to the IRS. This means that you'll receive your tax form similar to a W-2 by January 31st of 2023 for transactions that occur during this calendar year. The new rules apply to individuals, partnerships, LLCs, and corporations. It should be noted that Zelle has pushed back and claims that since it doesn't actually settle funds, that the law does not apply to them. Now, you're probably wondering if you're going to have to pay taxes on these payments received. Even if you didn't receive a Form 1099-K in the past, you should have reported any taxable income received through Cash App transactions on your tax return. The new rules simply make sure that this income is reported. To be clear, this new regulation does not add a new tax. You have always been required to report income over $600, and it's been that way for decades. With the new regulation in place, only the reporting requirements of using Form 1099 have changed, and now the IRS will be notified of your income from cash apps. Money received as payment for a service or goods is considered income and must be reported. Money received through cash apps can reflect a wide variety of scenarios. For instance, if you rent your Airbnb and you get paid through a cash app, the money received is reported or must be reported and is considered taxable income. If you clean houses or babysit as a side job and you make over $600 from any single party or more than $600 in combined payments, you must include this income on your tax return. The same applies to someone that earns money selling items on eBay. Remember, the IRS will be furnished with this information beginning this year. Now, there are certain transactions that can be excluded from income tax. These include certain kinds of peer to peer payments, such as money received from a friend as a gift, or money received from a roommate to pay their bills, their portion of the bills, or maybe a relative reimburses you for your contribution to a family party. Also, transactions for another business using a shared account are not considered income to you. If you receive more than $600 through cash apps, you will receive a 1099-K in 2023 for the transactions that occurred in the 2022 tax year. In most cases, you will report this income on Schedule C filed with your 1040. Now, the forms may differ based on your business structure. As an example, a Schedule E form would be used by S corporations and partnerships. It is vital that you keep accurate records of Cash App transactions. If a friend reimburses you $20 for half of a meal, that amount will be included on Form 1099-K, even though it isn't taxable. To accurately calculate the reportable income, you must have good financial records that identify which transactions were personal, non-taxable transactions, and those that are considered to be income. For this reason, it's recommended that you set up separate cash apps for business and personal use. So, to summarize, the new Cash App regulation isn't a new tax. Instead, the reporting requirements for digital payment apps such as Venmo and PayPal have changed. The only difference you might see in 2023 is a 1099-K that lands in your mailbox if you receive more than $600 in payments from cash apps. The new regulation ensures this income is reported and properly taxed. So make sure to keep accurate records and report all income sources on your tax return to avoid paying penalties and interest for underreporting. That's it for this episode of Just Jim. I hope to see you back again for another episode very soon. Thanks for joining me.